to another video from Creativo Solutions. You're currently watching the Finance for Non-Financial Managers video series. If you have any comments or questions, please post them below and consider subscribing to this channel so you'll be the first to find out when new videos are uploaded. Visit the website for more content to help you. We're on Instagram and Twitter, and keep watching our YouTube channel for more support. So far we've discussed the financial markets, and we know that the financial market can be broken up into two broader categories: the primary market and the secondary market. In the previous video we spoke about the secondary market as a market where we're actively buying and selling issued securities. In the primary market, we're issuing those securities for the first time. Most investors are going to access these assets through the secondary market because we'll be looking at buying and selling those assets that have been issued by the large corporations with assistance from the investment bankers. There are many different financial products that can be bought or sold, and we're going to be looking at the different types in more detail. We know financial products are important because businesses need capital in order to grow and expand their operations. Capital gives the business capacity in order to operate and generate income. Here we're going to be looking at two types of markets in the secondary market, which is the money market versus the capital market. Just think about them as two different subcategories. To keep it simple, we're going to look at it at a very high level view. The money market. When thinking of money, you're thinking of day-to-day transactions, whereby we're using cash in order to exchange that for some goods or services. When we're discussing the money market, we're focusing on short-term instruments. So we're looking at financial products that have been created with maturities of 12 months or less. When financial products are issued in the market, there's going to be a specific time frame associated with those products. There are many different short-term instruments that one can consider when either raising capital or when looking at possible investment opportunities. Those different types of products could be treasury bills, commercial paper, even negotiable certificates of deposit. These are all different short-term instruments that can be traded in the actual money market. Products that relate to short-term funds would be forming part of the money market. So always consider the time frame associated with that particular asset. We're looking at the product that's being bought and sold in the market. If the maturity is less than 12 months or 12 months, it's going to be considered a short-term instrument and it's highly liquid. Liquidity refers to how easy we can buy and sell these instruments. These products are considered more liquid because these assets have a shorter maturity. So potential investors would be more likely to buy these assets if they're seeking liquidity. These products are generally issued at a discount because the only way we can issue an instrument today in order to make some sort of return is to issue it at a discount. When focusing on discounts or premium, we're obviously considering the time value of money. We will be covering time value of money in a later video. For now, we're just looking at the different markets that are applicable in the financial management environment. We're obviously going to deal with different products and services, and we need to understand what actually makes up these different markets. So the money market is short term. Next we have the capital market. When you think of capital, you're probably thinking of starting a business. We've covered capital as one of the accounting elements in a separate video series. We spoke about the definition of capital, so we can relate that to this particular subject, which is financial management. We're focusing on capital market, meaning we're looking at longer term products. And these products are going to have maturities of greater than 12 months. The most common one that you'll see here would be government bonds. Government bonds are issued with longer term maturities. A bond is almost like a promise to pay, whereby the government is raising capital today and promising to make payments in the future. So when focusing on the capital market, we're looking at these products that relating to long-term funds. Businesses are raising capital today and promising to pay in the future. These instruments again are going to be issued either at a discount, a premium, or par, depending on the market interest rates. That's applicable to the time value of money concept again. When focusing on the capital market, just remember capital is looking at that investment that you're making in a particular business if we're looking at things from an accounting point of view. So the same thing could apply here if we were taking a longer term view into consideration. The money market is short term and the capital market is long term. We need both markets in order to have a well-functioning financial market, because businesses are going to be requiring those products and services in order to operate. That concludes this video. Thank you for watching, and please consider subscribing. If you have any comments, post them below, and consider liking the video, and we'll keep creating more to help you.